Federal Bank hosted an analyst meeting yesterday, and what are the key takeaways and whether Federal Bank is actually a buy at the moment or not. That's what we'll try and discuss. But before that, let's try and zoom out and understand what Federal Bank is all about. What has the path been over the last 5 years for the bank? Let's start off with the loan growth. The loan growth has been at around 14% over the last 5 years compounded annually. Deposits, in contrast, have grown 13% annually, so pretty much a good balance there. And we've seen NII, which is net interest income, which is your interest income for the bank less the interest expense for the bank, at growing at roughly 16% over the last 5 years or so. Provisions have been largely flat, but mind you, in the middle of those last 5 years, between 20 and 21, we had COVID, so provisions had gone up quite steeply, but they've come back straight off, and they're roughly at around 900 crore at the moment annualized, and we're seeing PAT going up 27% on a year-on-year basis. So what you're seeing is some operating leverage play out as well, and what you're also seeing is that provisioning and asset quality has improved quite dramatically. Let me take you through some of the provision numbers. The GNPAs have actually gone down from 3% to 2.4% currently at the end of Q3. So we've seen GNPAs go up to around 3.5% and come back off, and they've come off quite sharply, and that is very evident over the last couple of years. So that's a positive. But the biggest positive here is the provisioning coverage. Provisioning coverage is nothing but how well covered is the bank with regard to the provisions it makes. How much of that is actually recognized in the profit and loss account. It's basically a signal of prudence, and the higher the provisioning, the better, of course. So what we've seen is the provisioning coverage go up from 45% to 70%, 45% in FY18 to 70% currently. So we've seen a steep rise there, and which means that the bank is now well cushioned with regard to any downsides going forward. Further, net NPAs seeing a significant improvement from 1.7%. Net NPAs now are only at 0.7%. So you've seen a sharp fall in NPAs in relative terms. What we're also seeing largely is that the growth has not really stopped. The bank continues to grow, and the commentary of the bank also continues to suggest that they will continue to grow quite well. So now let's come to the main commentary. Firstly, the bank is looking to double up its net worth over the next 3 years. What does this mean? Currently, the book value per share of the bank is 100 bucks. What essentially the bank is saying is that the book value will double up to 200 rupees in the next 3 years. This is of course aided by the fact that there is going to be a fresh issue of capital also in calendar year 2023, and the bank did disclose that as well. What they are also suggesting is they aspire to be among the top 5 private banks in the country. That will of course, in terms of metrics, mean that NIMs and ROAs have to improve quite dramatically. Currently ROAs are at around 1.3%. The top quartile banks have an ROA north of 2%. So if Federal Bank has to get there, there has to be a sharp rise in profitability, which is what they seem to be penciling in. The other piece is on the NIMs front. Currently NIMs are at around 3.5% for the latest quarter, but otherwise for the year at large, we're expecting NIMs at around 3.3%. Most of the top 5 banks have NIMs significantly north of 4%. So what we're also expecting is that Federal Bank may move that needle upwards. How will they do that? Well, they're going to do more of unsecured, more of MSME, more of CVs, which will mean higher yielding assets. And as the yield on assets goes up, the NIMs will also start to go up. So that's broadly the story which is expected to play out, or rather the management has spoken about. The levers are, of course, they're going to grow their branch count. They're going to grow over the next 2.5 years. 250 more branches is what they're going to add. They're also doing very well on the fintech side. They've partnered with fintechs. They're also doing well on the digital side and branch banking. So they've got all those levers to ensure that growth starts to come through. So those couple of factors will obviously aid Federal Bank going forward. Lastly, is it a buy? In terms of valuations, currently price to book roughly 100 rupees FY23 end. The current market price is at around 132 rupees, and price to book, essentially that's how we typically value banks, is at 1.3 times, right? So that's the multiple currently. Most banks in that kind of a space are valued at around 1.5 to 1.6 times, but let's say it continues to be valued at 1.3 times, in which case, because the book value will double, the stock price ought to also double, which gives a very solid 25% return for investors over the next 3 years. In fact, when I'm making it more conservative, so the last 5-year average price to book multiple for Federal Bank is 1.1 times only. So if the book value were to double from there, then the stock price would become 220, still giving investors a very healthy 20% compounded annual return over the next 3 years. So even in a conservative possibility, there is a good chance that if the bank meets the metric of doubling up on its net worth, then there is a very good return available for investors. Lastly, let's go to the good case scenario. Say the bank becomes a top 5 in the country, one of the top 5 banks, and the net worth doubles up. So both of those happen. Then the bank would typically offer a return of 35% over the next 3 years on a year-on-year basis, because the price to book would shift from 1.3 times currently to 1.6 or 1.7 times, thereby closing in that gap with IndusInd Bank and Axis Bank, which are currently the top 5 within the top 5 private players. So there seems to be a good buzz around this stock. Even in the analyst community, 92% of the analysts have a buy rating on the stock. Also, 8% of the balanced analysts have only a hold rating. They don't have a sell rating. So there are no analysts with a sell rating. Out of the 37 analysts on the street, pretty much no analyst has a sell rating. The average target price given by all analysts combined is 166 rupees. That's a 12-month price target, giving a return of 26%.
If you like this video, then like, share and subscribe to ET Now.